Last thing we're going to do here today, actually, we're going to try a new segment out today. Greg Old Money Holmes joins us each and every Thursday, and he is a fundamental analysis master. I mean, this is something that he's really focused on for his entire career as a trader. He brought his, old money ways, his old money thinking, his old money analysis, and his training into his trading as he started in the markets and really focused on fundamentals. And that's what we're going to do today. This segment is called A Focus on Fundamentals. And what Greg is going to do is put the fun in fundamentals. Greg, I believe you're going to highlight something around PE ratios today. What do you got for us?
Yeah, so fundamentals, it's not it's about a perspective thing. First off, I'll qualify it with that. We're not looking at a day trade or a swing trade when we talk about fundamentals. We're looking position and we're looking investing. Now, because I was a financial advisor many years ago, the whole mutual fund business was based on fundamentals. That's how they built out these portfolios, things like that. So I took that training and kind of built my own stream of portfolio building techniques, if you will, and fundamentals plays a large part in that. So I basically, in my head, in my methods, broke it down into kind of two different categories, if you will. There's financial or fundamental stability of a company, and then there's fundamental valuation of a company. So it's kind of like, do I like it long term? Do I think it's a good company? That's kind of one side of fundamental analysis. And then the other part is, am I getting a reasonable price? Am I getting a fair deal? Am I getting value from it? You listen to the greatest fundamental or value investors. This is the fundamentals are what they look at. And so for me, I kind of split it into those two things. And so the rabbit hole we're going to go down first in this segment and a few others is we're going to start with the valuation part of it. And then we'll talk more about how we find the companies that we really, really like. So if we think about price earnings ratios, again, we're trying to ask ourselves when we look at these things, are we getting a fair deal for buying into this company? When we buy into a company, we are paying a certain amount to get a portion of what they make, which is our priced earnings. So the price is what you pay, right? The earnings are what you get. You get a portion of that earnings, right? So it's a value metric. It's like, okay, am I getting a good deal, right? You go buy a car, you pay $50,000 or $100,000. How do we know that we're getting a good deal, right? So you need to have something to work off of. So priced earnings to me has always been what I pay to what I get. So the price of a stock could be $100. If they've got $1 in earnings, that means I'm paying $100 for $1 of earnings. That's 100 PE ratio there. Well, what does that mean exactly? Well, unless you're comparing that PE to another company in a similar sector, in a similar industry with similar traits, it really doesn't mean that much. But when you start to compare those two, then you can kind of get a value perspective of it. And so, the ones that I thought about today were Coke and Pepsi. Okay, so nobody can argue that Coke and Pepsi are not in the same business. They're absolutely in the same business. However, they're very different prices, right? So the Coca-Cola is a $54 stock. Pepsi's 100 and something. What do we got for Pepsi? 154. So you got two different stocks. Now the question is, they're in the same business. How do I evaluate? Okay, what's a better one to be a part of, right? And so that's where price to earnings ratio can come in. We can look at a PE ratio and we can say, okay, we need to pay a certain amount to get $1 of earnings. In the case of Pepsi here, and all these numbers, by the way, are coming from FinViz. So in the case of Pepsi company here, we're looking at a PE ratio of 26.06. So essentially what that means is we're paying $26 in price for $1 of earnings. Okay, so like I said, in itself, that really doesn't really tell us that much. But when we can go look at another stock that's in the same business, right, and we can say, okay, well, Coke does the same thing as Pepsi, but Coke's 1/3 the price of Pepsi. So which is better to buy? Well, like I said, Coca-Cola has a PE ratio of 29, whereas Pepsi has a PE ratio of 26. So even though we're paying more money for those earnings, we're actually paying less. We're getting better value from Pepsi from a pure price to earnings standpoint. So we're paying $29 for $1 of earnings in Coca-Cola, and we're paying $26 for $1 of earnings in Pepsi. So when you just look at it across the board and you compare the two, just that one metric would say that Pepsi is a better value, not necessarily a lower price, but a better value than Coca-Cola. Now, that's not the only metric that you would ever use to compare these two, but it is one of the many fundamental metrics that we can use. And it's one that I use quite often when I start to look at, okay, do I like a couple of similar companies? Now let's go down and start drilling down into different metrics to see, hey, do I like this one better? Is there other things that I can look at? Price earnings ratio is one of those things.
Okay. Maddie, what do you think of the PE conversation here and Greg's, with Pepsi and Coca-Cola here? Any thoughts on this?
P ratio is a fantastic, very simple way to understand the valuation question, and that's the question that every investor should at least go through the thought process of making when they're making a decision to invest in a company.
Mm-hmm.
Too many times we make decisions based on dollar figures, right? We see, like I hear it all the time, Oh man, XYZ. It doesn't matter what the company is. Give me any company, any company.
Chipotle. We talked about it. Yeah.
Thank you, troll. Chipotle, right? You can see it right now. Everybody looking at Chipotle saying, "Oh man, I wish I would have bought it at 1,200." Right?
Mm-hmm.
Well, what does 1,200 represent, other than just the price you're paying?
Mm-hmm.
Right? It's not, the price is literally has very little to do with it, because price is just what you pay. Your position size is based on price divided by, how much you're willing to put in from a position size perspective. And so the price is just what you pay. Warren Buffett said this better than I could. Value is what you receive. And so when you look at the price, too many times I think we as traders simply look at the price of an instrument and we assess the value simply from our understanding of price relative to history, when what we should do it is price relative to performance. And that's from a value perspective. And so when you're looking at the P ratio, a P ratio is a very simple way of understanding the valuation question that investors absolutely have to go through in making a decision to park money into a long-term investment. Because what the P ratio states, and you can do this on any company, but let's go to, you asked me the question of Chipotle, right? Mm-hmm. Let me take that down. Okay, so you asked me the question of Chipotle here. So let's go to Chipotle and let's look at what 1948 represents. Well, if you're looking at 1948, what that represents, ladies and gentlemen, let's understand this more than anything here. You can see that valuation right there. So I'm erasing things. You see that valuation right there. Okay. So what that represents is based on current CMG's earnings report, based on their earnings per share, it will take 92 years for you to pay off the investment. Now I'm 43 going on 44, and I do plan on living to 275. Sell research, guys. Mm-hmm. But that might not occur. I don't know if I'm willing to put my money in CMG and wait 92 years to actually make a profit off the investment. Now, again, there's many metrics of how you can make money as a trader. This is simply just telling you one. It doesn't tell you growth potential. It doesn't tell you cash flow potential. It simply tells you that if you're paying $1,948, based on its recent earnings EPS number, it will take 92 years for that to pay off. Well, what Warren Buffett said, as taught by Benjamin Graham, the wonderful, wonderful, wonderful author of The Intelligent Investor in the early 1950s, what Benjamin Graham said is and this is how fundamentals or technical analysis works. It starts working based on somebody's assumption, and then other people start using it. Well, what Benjamin Graham studied in the 1930s, 40s, and 50s and taught Warren Buffett was that a P ratio of right around 20 is kind of where you want to be in your zone, mm-hmm. right? That gives you some degree of fair market value, right? Because if you can park your money into an investment, pay off that money based on EPS numbers in a 20-year time frame, that's about 2 market cycles, guys. You take onto that, you put the cherry on top of that nice little dessert called a dividend. You're compounding. CMG it's not going to pay you one, but again, we're just using, you gave me CMG
example.
to use it as an example.
Mhm.
Well, we're also going to capture the dividend. And you know what we're also going to do? We're going to write covered calls against it because Warren Buffett's a cash flow compounding king, right? And so we're going to do that. So all the PE ratio states is the amount of years it's going to take for you to pay off the investment based on the EPS number. And so that's what it basically states. Now, another version of the P ratio, if you want to understand that, to understand market valuation, is if you go to what is known as a Shiller PE ratio. And what a Shiller PE ratio is it's after the famed price economist Robert Shiller. And what Robert Shiller basically argued is that when all you do is take price divided by earnings per share, it does not give you an accurate measure of true fundamental value, given the fact that the price can fluctuate quite aggressively against the earnings per share. So, for example, price fluctuates every second of every day, and it can do some very, very crazy things in the short term. Well, fundamentals track over time. And so what Robert Shiller basically says, he took the CAPE ratio and he basically did what is called a cyclically adjusted PE ratio, and that became known as the Shiller PE ratio. And the Shiller PE ratio can give you the same type of understanding from a valuation concern or a valuation opportunity in the broad market, the same way Greg was talking about it from a individual company perspective. And so as you can see, and again, the stock PE ratios metric is kind of 15 to 20, right?
Mhm.
15 to 20. Well, the reason that is the case is, number one, that's what Benjamin Graham said to Warren Buffett, and that's what Warren Buffett said to us, right? Us as collective market participants. It became known as a standard. Well, what Robert Shiller said was, we're going to track this historically over the last 100 years in the marketplace. And what we have found is the average, medium, or mean is about 15 or 16. And so that's what we would consider fair market value from a longer term perspective in the broad market. And so you can do the same thing. And again, the only point I'm trying to make here is you can do the same thing from a market perspective as you do from an individual stock perspective. And what I've kind of adopted for myself is I adopt the Shiller P ratio as the standard against how I judge all other valuation metrics. And so, and by the way, it's not necessarily against the S&P 500 itself. It's more against the S&P sectors. And so what I'll do is I'll look at Coke compared to Pepsi compared to the actual sector itself to really assess fundamental valuation. Because when you're looking at Coke and Pepsi, one with the 26, one with the 29, the difference is 3 pennies on the price tomorrow. And so I don't really see, and I'm kidding with the 3 pennies, but you get the point. The point is there's not a lot of fundamental valuation difference in those two metrics. But if I would have compared that against the actual consumer discretionary consumer goods sectors, you might have a different take on the net understanding of valuation of Coke and Pepsi against the sector itself. And so and again, this kind of is getting into everything I do from a top-down analysis perspective.
Sure.
But I just wanted to show an example of the Shiller P ratio as Greg was talking about the stock valuations as well.